the growers were, their financing was cut off.
Hello again, everybody. Welcome back to the Comstock channel. I'm Marlin Bohling with you. I'm joined by Eric Relph of Comstock Investments today. Make sure you like these videos and subscribe to the videos as well, and share them with others to pass along the information. We always enjoy talking with you. Today we're going to recap the trading week here as we came into the end of the trading week, heading into the weekend here. It was an interesting day here, Eric, on the grain trade. We had a bit of a topsy-turvy action in the corn and soybeans. However, they wanted to pick on the wheat for some reason here all week long, the way it seemed. Yeah. And I guess I'll leave it up to you. You can take your pick. Fielder's choice today, now that we're in baseball season. What do you want to talk about first?
I would say first and foremost is the one that's biggest on everyone's mind right now, and that's the corn. Obviously, Monday is the prospective plantings and quarterly stocks report. That's where the attention is, and that's definitely what's steering the trade right now as everybody tries to square up ahead of that report. Today we traded 7-8 cents lower in nearby May and finished the day 3 cents higher. So you're a dime off the low. Nice little recovery to finish the day. Still not a great looking week, but we'll take the win for the Friday and see how we can roll into Monday. We did get down and tag the low that was posted on March 4th in that May contract at 442.5. We actually made a new low by a bit, hit 442 smooth, bounced right back. We're trading above 450 for quite a bit of the last portion of the session today. So really a nice turnaround, nice finish. And I think that's indicative of the idea that maybe the bearish potential of this report is already baked in, and traders are starting to go, well, maybe it's overdone to this point, and we've got to go the other direction. I've been one of the few in that camp that maybe we see somewhere between 94 and 95 million acres, and that still warrants a bullish reaction. That's not a popular opinion, but this is just one of those times where if you don't quite get the worst case scenario, you may already be prepped for it.
For technicians that look at the May corn contract there, that was a huge outside up day. In other words, it's almost like a key reversal in a way.
Yeah, it was definitely a remarkable day on the chart, and a lot of candlestick guys, myself included, will make note of those kind of sessions. I'm just going to take a look here at the May specifically, and we can bounce around if we want to, but the only thing we didn't do to create the key reversal was open lower. But we did trade to a new low. Again, went back and tried to test this low from March 4th and then finish, fairly notably higher. Again, a bad week as you look back at the prior few sessions, but still a nice conclusion, leaving that big tail down there. And you can see what happened the last time we did that. We went straight up for 4 sessions following. So maybe we've set the stage for something like that. But Monday's data is going to tell the tale.
Now, a lot of talk about the quarterly stocks report. And a lot of traders tell me that has more potential to be a market surprise than the actual prospective plantings report. What do you think about that?
There's a lot that goes into those stocks reports. There's a lot of moving pieces to try and align. And the USDA oftentimes will rob Peter to pay Paul in those, because obviously it's a supply and demand report, So if we're looking at the potential for a reduction in feed usage, are we going to leave, are we going to increase export usage? The demand for corn exports from the U.S. has been robust, 30-some% above the USDA's projection at this marketing year to date. And so there's a lot of this give and take that could go on. I have a hard time thinking that we would have a bearish stocks report as well, simply because you've got all these cattle that are being fed to 42 pounds heavier than year ago levels. And you lose efficiency when you get to those heavy weights. Cattle are the highest consumers of corn for feed. And when you're adding that kind of weight and running these animals up to 1,700 pounds in many cases, you're losing a lot of that growth efficiency and having to feed a lot more feed to get those extra pounds. It works out in the end because you're getting more carcasses grading prime, you're getting more tonnage. And so it is worth it. But still, the consumption is increased, even though you may be feeding fewer head of cattle because of that lost efficiency and higher weight. So I don't really know how you can paint a bearish picture with better exports and perceived lower feed demand, but I don't know that you can necessarily say that. Now, what I don't know about, and what hardly anybody knows about, is what kind of impact the poultry side will have on that. how much reduced feed demand we have because of avian flu over the last several months, and that'll be a big factor. That it's such a integrated market that we really don't get good data in that regard.
Wednesday, a couple of us were talking about the fact that on the May soybean chart, if you go back to, in my case, at least the charts that I was watching and using, if you go back to like mid-December, it looked like we're just in a giant coil formation, and it just kept tightening up and tightening up. And it looked like we were getting right at the point where it was decision time on Wednesday. And we talked about that. And I don't know. I mean, am I correct in thinking that it blew out that coil today, that wedge formation to the upside?
So yeah, as you look at the May soybean chart, you can definitely see that topside breakout here over the last two sessions. Really, you kind of had a multi-point trend line resistance. Yesterday you broke out, close above it. Today you get follow through to the top side. The only problem is now we've got the 100-day moving average sitting just 4 cents above the closing level here today. And so that's going to provide a little bit of resistance. That's also where the top Bollinger Band comes into alignment. So some tough stuff to get through to think that we could just keep right on motoring, but definitely a breakout yesterday and follow through today. Nice to see.
Well, a few of us have been talking about the fact that it seems like the bears have definitely been in control on the soybean side, and it's like they've already thrown everything at it, including the kitchen sink at this point.
Well, and that's kind of the feel you get. I mean, you look at how we just kind of fell off a cliff here back in late February and early March, and just like every other grain market, make a low on March 4th, rebound pretty decent, and then to your point, start coiling sideways and just grind it out for a while. This all while we're talking about, reduced export demand and, just a variety of negative factors coming in to talk about. And then all of a sudden you see this kind of explosion. Well, this was definitely triggered by a fundamental factor, and that is the fact that Trump has told the biofuel and big oil groups to figure it out and come up with a policy that would integrate U.S. feedstuffs into the biofuel equation. And what is that going to look like moving forward? And as I've talked about with you before, and I always try to mention this to people every chance I get with regards to clean energy. Back in the early 2000s, at that point, the biggest wind farm in western Kansas was being built by Duke Energy. So they know that they need to diversify and they need to spread out to get some of those carbon credits moving forward.
All right, talk to me about this wheat trade. How much damage have we done to the wheat market?
It's nasty looking. There's no question about it. Technically, it looks like a complete failure. Fundamentally, there's another storyline there, but the market is just disregarding it, and the funds continue to pile in. The open interest increases, and we continue to fail to see any kind of recovery when it's probably fundamentally warranted. The HRW specifically, I mean, you can look at the rain forecast over the next 7 days, and there's a lot of moisture supposed to hit the central U.S. However, it just carves out a cavity around HRW country. It's remarkable. I always used to say, well, put up our umbrella, we won't get anything. And that's kind of how it goes out there. But, from central Texas all the way up through the panhandles into western Kansas, they're not really supposed to get anything. Now, as usual, you draw a line up I-35 through Wichita, and everything east of there is going to get some rain. But west of there, nothing. And that's the heart of the HRW country. So today we made new contract lows in the Chicago contracts that really matter the most, but KC failed to do so. We could see a test of those lows even more so than what we saw today. We got within about 3 cents today when it was down 22 for the session. And if we do go back and hit those marks, we may uncover some buying because fundamentally it's probably warranted. But the technical outlook is terrible right now.
Well, it seems weird to me. I heard several analysts earlier in the day attribute the weakness to the fact that we may get a ceasefire between Ukraine and Russia. And it seems real weird to take that big of a bite out of the wheat market if that is their reason. Like you say, the weather does not really seem to support it that much.
Well, not only that, but go look at Russia and Ukraine's export numbers over the last 2 years. They haven't been dramatically impacted. It's not like all of a sudden they're going to start shipping grain that's been sitting still. No way. That grain's been moving. And so to think that this would have any real impact to the flow of cash wheat, no, not at all. And I think that reality will hit them as soon as they do realize, oh, the pace is still the same.
Well, all right, let's talk about livestock here. As far as the cattle market, I see where we closed a little lower on Friday, but there again, it seemed like another session of whipsaw type trade here.
Yeah, it's remarkable that we're continuing to see the open interest increase in the cattle complex. Every little break gets bought, and so yesterday's a prime example. You trade like a $5.50 range in the feeders, $4.50 range in the fats. A couple of contracts even traded a $5 range in the fat cattle yesterday. But what you're seeing is you're seeing these sharp breaks on maybe profit taking. But if you take profit between steady and $2 lower on the day, and then all of a sudden you have the opportunity to buy it back at $4 lower on the day, managed money will do that all day. And it seems like they're doing that. And so every break gets bought. Unfortunately, we haven't been able to get back to last week's highs to maybe uncover some more hedging opportunities. But when your dollar's off the highs, folks are a little reluctant to do much hedging, even though maybe it's the best thing they could be doing. So trying to manage that risk, several dollars off the high, is vital. But we could go back and challenge those highs. There's a lot of prognosticators calling for astronomical numbers in both feeders and live cattle, 320 feeders and 250 fats and things of that nature. I will say I did hear of a couple of deals, and this is not enough to set the market, but a couple of deals done in Iowa today at 222 live.
All right. Now, just to call attention to an earlier podcast that I had posted on Thursday with Daryl Peel. I don't know if you happen to catch that one, Eric, but he was alluding to the fact that he does not think the highs are in yet. And he said, even if we start rebuilding the herd right now, he doesn't see the herd rebuilding until 2028, just because of the gestation periods and everything. And before you really start to accumulate some numbers. He thinks we're 3 years away from it yet.
Everybody always says 2 years, right? From the time you start really, meaningfully retaining heifers, it's 2 years before you can get a good calf crop. And so everybody feels like that's or a marketable calf crop, I should say. So everybody feels like that's kind of the general rule of thumb, is at 2 years. And so the question becomes, have we done any meaningful heifer retention yet? We know that these bred pairs and first calf heifers and, all of these markets have just been on fire. So people are anxious to buy them. It's just a matter of what are they doing with them? How long have they had them? When did they buy them? Now, I did, and this is an anecdotal case where myself and Brandon Hamel, the auctioneer and general manager of Heartland Regional Stockyards in Plainville, Kansas, we went through and started looking at numbers over the last 5 years. And they actually had started showing signs of retention a full year ago. Now, not in a meaningful way. So where do you draw that line? And when do we actually say we've crossed that starting line? I can't think we're there yet, because what happens is even though they may not be coming to town on a given time, because they're being retained, the prices go up, go up, go up. Eventually everybody goes, well, I can't hang on to them. They're going to go, And I've heard cases of cattle getting sold 1 week for breeding stock and coming back to the barn 3 weeks later to be sold. So some of these things are going on all over the place, and the volumes are just, they're definitely remarkable considering the environment that we're in.
Do you consider this hog market as we came into the weekend? Do you think that was a fail for this week or not?
Absolutely. With that bullish hog and pig report on Thursday, and then come out and do absolutely nothing on Friday with a $4 higher midday cutout, this was a face plant to end the week. And, the Packers have been buying aggressively in the cash market. They don't typically do that. The volumes that we've seen are 3 and 4 times what you would normally see on a given day in several instances over the past week. And the market's just unreactive. Today, we did absolutely nothing. Actually spent more time in the red than we did in the green across the board. And then you've still got these summer months that are several dollars back of the $100 mark, where probably you got to get back to uncover any real hedge opportunities for most folks. But I don't really know how to read this market, because again, it's one that's so integrated and consolidated that it's hard to get good information. There is some stuff going around about some feeder pigs that the growers their financing was cut off. 100,000 feeder pigs in southeast South Dakota without feed. And so Tyson was getting involved and Farm Credit was getting involved, and they're trying to figure out what they're going to do to keep these animals fed and moving forward as their funding was cut from a Canadian bank. So there's all these little anecdotal things you hear about in the hog market. But at the end of the day, the one that you hear the most about, well, two really, is how extreme PRRS is. And that can be decimating to a herd size, and how many empty hog buildings there are. So there are some indicators out there, but again, it's difficult to get good widespread information.
Yeah, and again, that hog market seems like it's caught in a consolidation mode right now, just kind of going sideways for a better part of a month, the way it looks.
It's wide ranging, but it is sideways, no doubt. I mean, when you have a lot of $2.5, $3 days mixed in there, it makes the ranges pretty broad, but still sideways nonetheless.
About the only thing I can say that's positive is it is staying above that 200-day moving average and staying away from it a little bit too. So I don't know if that'll support it or not.
Yeah.
Well, I appreciate all the information here as we wrapped up the week. And now talking about decision time, it's going to be Monday at 11 o'clock in the morning. We will get the quarterly stocks report and also the prospective plannings report from USDA. Matthew Cruz and I will be talking about that right after those numbers come out. So stay tuned for that on Monday afternoon as well. But in the meantime, Eric, thanks for all the information you provided today. Hope you have a great weekend. We'll catch up with you down the road as well. All right.
Thank you, Marlin.
Eric Relf of Comstock Investments. And we thank you for joining us. For producer Breanne Jenkins, I'm Marlin Bohling. We'll catch you next time right here on the Comstock channel. Futures trading involves risk. The risk of loss in trading futures and/or options is substantial, and each investor and/or trader must consider whether this is a suitable investment. Past performance is not indicative of future results.